Hey guys, it's that Dividend guy. Today I've been getting a lot of questions about SCHD on Instagram, so I wanted to go over the ETF. I know this is a super popular one in the dividend growth space here on YouTube, and I just wanted to take a look at its performance, what makes up this ETF, and why it is such a good option for dividend investors, and then kind of give my opinion on whether or not I personally will put my money into it. So guys, let's jump right in. For today, it is up about 24 cents. For the week, it is up 92 cents. The 1 month mark, it's actually down about $1. 3 month mark, it's down almost $2. For the 1 year mark, again, down $1.50, down about 2%. And then for the past 5 years, it has gained $26.05, up 52%. So if you're a long-term investor, you're definitely seeing some great appreciation from this ETF. But guys, take a look at this. So it was up from, like, I think its inception was like 2018. Up, a little bit of a drop down in 2018. Look at that. That is definitely COVID right there. Could have gotten this at $44 and nearly doubled your total investment there. That is phenomenal. I mean, I know COVID hit everything hard, but that is quality at a quality price there. And then of course it goes up until all the way up until July, and then a huge drop here at $66. So it looks like in October or the end of September, you could have gotten this ETF at $66, which would have been around the same amount as last year in January of 2021, January, February area. So a couple of really good buying opportunities there. So if you got into SCHD at that $40 to $44 mark, geez, you've been making a killing. But let's take a look and see what this is. So SCHD tracks the market cap weighted index of 100 dividend paying U.S. equity. So there's only 100 dividend paying stocks in this ETF. That's the big difference between this and VU or SPY, is this is 100 dividend paying companies instead of the mixture of, say, like Facebook, Amazon, Netflix. Like, some of these big tech companies don't pay dividends, so you're not going to get any of that exposure when it comes to this ETF, which is totally fine. If you're a dividend growth investor, this is the type of ETF that you want to be in. But if you're looking for more diversification and getting a little bit more tech exposure, then VU or SPY would be better. But I can see why this is a highly sought after ETF in this space. So let's take a look. So for sector-wise, the biggest sector in this ETF is financial services, then sitting around 21.5%. Then we've got industrials at around 17%. Technology still has a pretty big footprint here at almost 17%. Consumer defensive at almost 14 or 13.5%. Healthcare is at 10.5%. Consumer cyclicals only 7%. Communication services 5.5%. Energy 5.5%. Basic materials is only 2.1%, and then utilities is pretty much non-existent. So this is the diversification that you guys are jumping into when you buy SCHD. So financial services is pretty high. I'm kind of surprised to see that since it is so dividend focused. But there is a lot of consumer defensive in there and healthcare. So consumer defensive, healthcare, and communication services are known for their dividends. Industrials, not so much. And I am kind of surprised to see utilities so far down, because usually when it comes to that dividend just consistency, utilities are up there. But the thing is, though, if you're looking for dividend growth, utilities usually have a slow and steady dividend growth. Now, since we've gone over the overall diversification, let's take a look at the top 10 holdings of SCHD and get a little bit more focus when it comes to what is actually in this ETF. So first is Broadcom, which they are a dividend growth monster. So they have a phenomenal business model. They have double-digit dividend growth. I know Dividend Data actually he's my favorite YouTuber in the space, just switched out Intel for Broadcom due to Intel's huge dividend cut. So Broadcom, not surprised to see it there. It is super popular for individual dividend stock investors. Next, we have Verizon. Now, Verizon is one of the two big telecommunication services stocks. They are the one that didn't cut their dividend. AT&T has just recently done a spinoff, and it reduced its dividend by like 50%. Verizon has always been a pure telecom play compared to AT&T, so I'm not surprised to see Verizon here so high up, really rivaling, Broadcom here. Next is Cisco Systems. I know this is a slow, steady dividend payer. I think it's increased the dividend for a little over 10 plus years. So this is one of those I'm kind of surprised to see here. The dividend growth, I believe, is 5 to 7% year over year, which isn't terrible, but for steady dividend growth, I guess I would pick something more like a Lowe's or maybe and even in the tech field, Apple, but Cisco does pay a better dividend than Apple, or maybe even Microsoft over Cisco, but I do know it is a relatively popular stock when it comes to dividend investors. Next is Texas Instruments, which they are a phenomenal dividend company. Nice metrics, overall growth on the revenue, and the consistency in the dividend is really unparalleled. Double-digit dividend growth for the past, I think it's 10 to 15 years. They are just insane when it comes to dividend growth. Same with Broadcom. Texas Instruments and Broadcom are kind of in the same boathouse when it comes to the dividend growth. And I do also know Dividend Data owns Texas Instruments. It's one that out of the four there, out of Broadcom, Verizon, Cisco, and Texas, I have owned Verizon for a little bit until I thought that it was overpriced. Texas I had never have owned, but I have looked deep into Texas Instruments, and I do love that. Then Lockheed, this is a common defense stock. They are one of the most popular ones, as well as General Dynamics, so not surprised to see that here. Steady Eddie earnings growth, pretty consistent year-over-year growth, and pretty consistent dividend growth. I do know that General Dynamics is a dividend aristocrat, where I believe Lockheed's done 17 or 18 years of dividend growth. It might be a little bit more than that. I don't pay attention a lot to the defensive sector because it's not in my wheelhouse. But I do know Lockheed is very popular among dividend investors. Next, we have Merck, bit of healthcare here. For a healthcare stock, when it comes to dividends and consistency, I think J&J can't be beat. So I'm kind of surprised to see Merck here. I do know that they have, I believe, 15 years or more of dividend growth. Like, I think it's 10 to 15. So they're pretty consistent as well, and they have a relatively formidable dividend growth rate. I believe it's 7 to 10%. So they're doing okay. But again, J&J would be my pick if I was going to be looking for an ETF for healthcare exposure. I'd definitely be choosing J&J. Next, we've got PepsiCo and Coca-Cola. Now, they are relatively the same when it comes to the weighting in this ETF. PepsiCo is a little bit more, but of course they have the snack food giant that is Frito-Lay. So overall as a business, I do think PepsiCo is a bit stronger, but I do know that both Pepsi and Coca-Cola have reliable earnings. They have great branding, which gives them pricing power year over year, case by case basis. They sell more cases every year. They can bump up the price, 1 to 3%, whatever they need to do, because they have that great track record and that consistency of growing profits. So I'm not surprised to see both PepsiCo and Coca-Cola here. When it comes to the brand, I know Coca-Cola is stronger, but when it comes to the overall dividend consistency and growth, Coca-Cola does actually have them beat. They have 50 plus years, and I know Coca-Cola has been a dividend king, but PepsiCo just crossed aristocrat into king status. But I know PepsiCo does have more aggressive dividend growth, so I'm not surprised to see it a bit higher here in the overall percentages. Then we've got Home Depot, which, again, just like I said with Merck, I think Lowe's would be a better consistency play here. But on the flip side, I do know that Home Depot, over the past, I believe, 10 years, has had a stronger growth rate than Lowe's. Lowe's did just do a huge dividend increase, so that might kind of tip the scales more in Lowe's favor, but Home Depot's still a great pick here. And then, of course, BlackRock. They are flipping huge. They pretty much own everything when it comes to marketable securities in business. They are absolutely nuts, so I'm not surprised to see them there. So, guys, overall, I do like the ETF. Of course, I would switch out a couple of these options. I'd keep Broadcom. When it comes to telecommunication services, I wouldn't even put them in this ETF, but I know why Verizon's there. It does have that consistently high yield. When it comes to tech, though, instead of Cisco, I'd be putting probably Microsoft in there. Texas Instruments keeps its spot. Lockheed, I'd switch for General Dynamics. Merck goes bye-bye for J&J. If I had to pick one for consistency, overall dividend growth, I own Coca-Cola. I'm long Coca-Cola. It's my favorite stock. But PepsiCo in an ETF I would see is more popular, so I'd keep PepsiCo. And then on Honestly, you could probably keep both of them in there. And then instead of Home Depot, I'd switch it out for Lowe's and BlackRock. I don't really have um, I don't have a lot of knowledge on that company. I've done a little bit of a deep dive on them, but I mean, I keep them there because they pretty much own everything. So overall, guys, I do see why SCHD is such a popular ETF. But when it comes to dividend growth, I think they have a couple of really good picks in there. But I do think that they could switch out a couple. So, like, let's say instead of Verizon, they did AMT. They are American Tower Corporation. They have kind of the same business model as Realty Income, and that meaning they rent out or lease out these huge telecom towers, and they have done consistent quarterly growth every single year for the dividend. So I see why Verizon's in there, but if I had to switch a telecom out for something else in that sector, it would be AMT. So I would nitpick and switch a couple of things about this ETF just personally, but I do get why these are there. These companies are chosen. Keep in mind, guys, these are just the top 10 holdings. So, of course, AT&T might be in here. Lowe's might be in here. J&J might be in there. Eli Lilly could be in there. I haven't looked at of course, I haven't looked at all 100. I'm just basing it off of the top 10 because keep in mind, guys, 40% of your overall investment is going into these 10. So I usually focus on the top 10 because that's where the bulk of your money is going, because even though percentage wise, so like let's say there's only 40% in the top 10, right? But that extra 60%, after you get down to like say like 3.5 to 3.2 to 3.3, like it all adds up to 60%, but the last 15 companies probably have 1% or less in there. So they're not going to be as important when it comes to the overall ETF. The same issue is in any ETF, right? If you have 5% in Broadcom, you're not going to have 5% across the board. As you guys can see, it goes from around 5% down to 4, then stays at 4, then it just keeps getting lower and lower. So even if you have companies like, say, Microsoft or Apple, or even Lowe's or General Dynamics, odds are those weightings are so low that they're not really going to fluctuate the ETF as much as, say, Broadcom's movements in the everyday market. So overall, guys, I do like SCHD. I wouldn't put my money in it, but I do know it's very popular among dividend investors, and I totally understand why. I would make a few changes. Like I said, I'd keep Broadcom. I'd switch out AMT. I'd switch out Verizon for AMT. I'd switch out Cisco Systems for Microsoft, keeping Texas Instruments, switch out Lockheed for General Dynamics, switch out Merck for J&J, switch out Merck for J&J, keep Pepsi and Coca-Cola, they're fine, switch out Home Depot for Lowe's, and then I'd keep BlackRock. So I would make a few switches or changes here or there, but the stocks that are in there do have a reason for being in there. So with that being said, guys, let me know, how do you guys feel about SCHD? Would you make any changes to this ETF? Do you own it, and how long have you owned it? Like we looked in the price chart earlier, guys, if you bought this back in, March of 2020, pretty much if you bought anything in March of 2020, you're up, massively. So, awesome ETF. Not one that I would put my money in because I am more focused. I have about 10 stocks and I want to keep it that way. There are a total of 103 total holdings in this ETF, and overall, guys, it is a really well-performing ETF. It's got quality companies in it. You could sleep easy and invest calmly and not have to worry about overall market fluctuation. So you do get that nice broad diversification amongst great dividend-paying companies. You don't have to manage anything with this ETF if something cuts it. So I'm sure AT&T is probably out of it, and same with Intel because they've had, and VFC as well because they've all cut their dividends. So that's one of the carefree kind of easy things about ETFs is that somebody manages it for you. You don't actually have to put any effort into managing the portfolio. So thank you guys so much for watching. That's my overall take on SCHD. I like it. I understand why it's so popular, and I do think it's a great place to put your money if you're looking for a quality dividend ETF. Not the one I would pick overall, but if I had to pick between this or maybe VU, if I wanted a more concise dividend focused I would consider SCHD. So with that being said, guys, let me know of your opinion. Let me know your opinion down in the in the comments, do you like SCHD? What percentage of your portfolio is it? Maybe it's the only thing in your portfolio. Are there any companies that you would switch out? And if there are, let me know what you'd switch out. The big one for me is I would definitely switch Home Depot for Lowe's, and I would 100% switch Merck for J&J. But those are just the big ones I would switch out. Let me know down in the comments below, guys, how you feel about SCHD. Is it your one and only? Do you have a huge percentage of the portfolio in it? Let me know down in the comments below. Guys, remember to hit the like button on my channel, That Dividend Guy. It really does help get the videos out to more people and spread the overall message of dividend growth investing, as well as hit that subscribe button, guys. I'm trying to make daily content every single day. I'm doing the portfolio videos, and I'm trying to sprinkle in a little bit more content here and there just to keep, the channel consistent. So if you guys do appreciate that consistency, hit that subscribe button. Thank you guys so much for watching, and let me know of your opinion of SCHD down below. Thank you guys so much for watching. I'll see you guys in the next video. Take care.